Any hedge fund that was going to be in the sector, they would spend millions of dollars to do this. Well, nobody who was in the sector as deep as us, so we had to do it ourselves.
Wow. Hey everyone, welcome to the Trade to Black podcast as we continue our on-location podcast this week in beautiful Palm Springs, California. And we're happy to be joined once again with Rob Sechrist, who is the managing and co-founder of Pelorus Equity Group. Great to see you. How are things?
Great. We're having another awesome day here.
I know. We're at the BMW racetrack. Good to see you, Ben. How are things?
Great. Yeah. Going well.
We just cruised around, I don't know, 20 or 25 laps. I had to check out after about 6. A little bit of a pansy, to say at least, a little nauseous. But here we are at a racetrack. I know it's a huge passion of yours, but a lot of people are going to say, why are we here? Is there some sort of correlation with what you do and obviously with being associated with racing in general?
Yeah. Well, being here, we wanted to bring you here to see a passion of Dan and I and Travis. This is one of the things we enjoy doing on our own free time. And one of the things that I would assimilate to work related is discipline. So when you come out here and you're doing 140 miles an hour down the straight and there's a turn coming up, you have to be precise, you have to be accurate, but you still have to move at speed, but you have to be disciplined in your approach. You can't let your ego get in front of you and you'll make mistakes, and those mistakes can be catastrophic. So we come here, we train, and we use private instructors, and we've worked for many, many years to get to the level that we're driving at. And that discipline, you can only go so far with the feeling of the discipline and the actual looks of where you're looking for your braking points and your turn-in points. And eventually you move to a level where you start having data. And the data analytics is the way that you get the next few seconds out of that lap, because now you're past where you can sense where it was and where you're missing time. And so when you bring that data and you start overlaying it with what you're doing out here, it opens up what you wouldn't have known. And as Travis often says, instead of just looking with a flashlight in the room in a certain spot, when you bring the data, you can see the whole room, and you can get a better understanding of what was the turn and where am I missing it, and you can compare laps. And so at Pelorus, we're able to use our big data project to overlay all that information and look at the whole room instead of just that individual transaction. And so I think it's those two things, discipline and how we have our approach. It's the data that we're using to make sure that not only are we being disciplined in what we do, but we're using data analytics to proof it up and make sure that concept that we're the most efficient and we have the best fact base.
How does that work? Like, do your data proprietary tool, is it stationed here does it work only in the state of California, or is it all across the U.S.?
Yeah, so that data project has every single licensed operator across the entire country.
Wow, okay.
We recently even added Canada as well, and not that we're lending in Canada, but that is a more mature market, and we thought that there might be some ancillary information or analogs that we can pick up from that data set over there, because each one of these states, when it comes online new, it's the beginning of the data stream for that state. And so each state is at a different point in the maturity of that data. And so the more over time, the more we can track trends and look at how things happen, look at how each state comes online, look at what happens with new build outs as a state it becomes medically licensed in that state. And then it gets into more of a mature market where now you're getting to where you've got fully stabilized transactions in a more stabilized market.
Now, without giving up firm secrets, and this data set that you have, would it be something like more comprehensive than that you get from something like Headset or something like that, the public data sources?
That's a really good question. And so you have to think about Headset, New Frontiers, BDS. All of these companies are analyzing the data from an operator perspective.
Okay.
That's really important. And we look at that data, but that's for the tenants. We're trying to understand the data for the real estate. And in any normalized, mature market, you have CoStar or you have other real estate firms that are providing all this data. Well, nobody was doing it for the cannabis-related real estate. This is a specialty use real estate sector. And so any hedge fund that was going to be in the sector, they would spend millions of dollars to do this. Well, nobody who was in the sector as deep as us, so we had to do it ourselves.
Wow.
And so that's how we know today. We estimate that once all the real estate is built out, this is the real estate, not the cannabis operators. This is the real estate asset class. We believe that once all 50 states are built out, we're looking at about $50 billion of real estate assets.
Wow. So when I look at, do you have much competition when you talk about focusing on real estate towards this data that you're producing, while others are focusing on something completely opposite. What does the competition landscape look like?
So if the question is on lenders, we've got a couple of publicly traded, and we have about 100 privates that are lending. If you're talking about data analytics for the sector from the real estate side, I hear that people are going to try to do it because they've heard that we're doing it, and so they've got to be competitive to say that they're going down that road. But I don't know to what extent that they what they have. I'm not familiar with those companies. You know, as far as I know, we're the only one that has been in the sector since 2016. So not only do we have more time of information, the other two peers that are in the sector have only been here for one of them just over a couple, maybe 2 years, and the other one just a year. So they wouldn't have that robust data set that we have.
Now, Rob, perhaps you can quantify, what the opportunity is here in reality. Obviously, you said once the build out happens in all 50 states, we're going to go up to about $50 billion in assets. So are you still finding opportunities in this particular market where corporate defaults are rising, interest rates are rising, and the economy is slowing down? Or there's still plenty of opportunities out there?
Yeah, so in this cannabis specialty use real estate asset class, collectively, we believe there's about 2.5 to maybe 3.5 billion that's been issued in credit. So there's an enormous amount of runway for transactions to be done. This is specialty use real estate. It is totally different than your typical real estate asset class. We prognosticate that being in the cannabis sector, that revenue of 27 billion across the country or whatever it might be is still going to go on. It might not grow to 30 billion next year, or it might only be 29 billion, but that revenue is going to flow through each year. There's always going to be winners and losers, but in this particular sector, that revenue is going to keep going. Whereas if we were in a durable goods manufacturer, people stop buying when the economy goes like this, or a big ticket item. So these are all relatively small sales, $25 to $75 per person in a dispensary. That might slow down a little bit, but people are still going to continue to spend. Everybody's going to be impacted to some extent. We believe that we will be significantly less impacted than other real estate lenders are in the real estate sector.
Well, the key here from what I've learned this week is that you're on the private side, so it takes a lot of the volatility away from the actual industry itself. And a lot of conversations that we've had is the actual industry itself is barely even in the first inning as far as the overall growth. So when you look at, there's going to be tremendous opportunity for lending more in the future. Do you have an idea in the growth trajectory of what those numbers could look like in the next 3-5 years on the industry as it expands?
Well, so you talked about the equity side. So one thing that on talking about utilizing the capital markets, the publicly traded capital markets, is that this is truly only being driven by mainly retail investors, and that's not enough investor capital to move the market. So going public isn't going to be very much of a value add, and you're going to have significantly more volatility because you're so thinly traded. For us, where we believe that we believe that we'll round out this year at close to $500 million of assets under management. We believe we'll be in the $1 billion by next year. In 10 years, we'll probably be fully out to 2 to 3 billion total assets under management. And we think relative to a 50 billion market cap, that's a good size to be.
So what's that mean for your investors then that are investing in your fund based on that growth?
Well, I think that it's more about the experience. We've done 71 transactions for $513 million since 2016. We've now had, I believe, 37 payoffs. So we've just, what you should look at is the experience of who you're investing with. And we're a different lending model than our two publicly traded peers. We are as close as you can be to the true real estate lending model, as we only lend off the cost basis of the real estate. Our other peers.
What is that? Can you explain in more detail what that means?
So if you purchase the real estate for $4.5 million, and then you put another $4.5 million of additional tenant improvements and equipment into that building, that would be a $9 million cost basis. We will typically lend up to about 60% of that. So they got to come in with 40%. So we have more equity protection in these transactions than in typical real estate deals. Most real estate transactions, they probably land up to 85 to 90% cost basis and maybe 75 or 80% loan to value. we only lend off the cost basis. So our loan to values would be 45 to 60%, somewhere in there potentially. But the cost basis is the replacement cost is the most true metric that we use to analyze this. And so when you look at these specialty use properties, if we were to take one back, we believe that we would not only be able to reposition another cannabis use tenant in there, but we would turn that into a positive trade for our investors. It's absolutely not what we want to do, but we always have to be prepared to do that, and we would be able to do that.
Interesting.
And just to add one last thing, we do encumber the cannabis tenant operator license as well, but we do not give it any valuation. Our peers add that license and collateralize the license as well as we, but they give value to it. They also give value to the accounts receivable and the enterprise value of the company. And that lending model is, you can end up with a lending basis. If ours was 100% cost basis, they might be up to 150 to 180% higher lending basis than us. So that model is just way out on the risk profile than us. And you're getting out to like an equity REIT where the first dollar loss on an equity REIT is actually the most exposure. That's a lending model that is for a fully mature, fully stabilized market, not a market that is newly emerging, that you're setting lease rates for the next 15, 20 years, that those lease rates are never going to be competitive in the future because it's not a normalized market.
Right.
Well, I feel like that's an important point, and that's where I was going with my next question, is that if you're invested in the fund, because you're taking such a conservative approach to collateralization of the loan, then investors, you don't worry about corporate defaults or anything like that, or non-performing loans, because you're protected. Right?
Yeah, I mean, it's not that we don't worry about it. We always are looking at risk and managing risk. But what I would say is that we would be less impacted by having to take a property back. We have significantly more equity dollars protecting our loan possessions than typical real estate transactions. And these are things that most people wouldn't realize just talking broadly about this. They're not going that deep into the underwriting of our peers and the other privates out there.
So let's talk about this deal that happened a couple of weeks ago, the lending of the $45 million with TerrAscend. A lot of MSOs want a high ceiling when it comes to lending dollars. They look at the maximum amount of dollars that they could possibly get. $45 million was the number. What's this present to you as far as opening up the door for other MSOs? And most importantly, maybe elaborate a little bit on why the more, I don't want to say conservative because $45 million is a lot of money, but why did that amount make sense?
So that transaction was originally, they were considering doing other types of structures.
Okay.
And that could be a range of a sales leaseback for maximum cash out. So that's the highest. Or the next model is the corporate debt model, where they're going to go and get the lending basis off of their licenses, their corporation value, and their accounts receivable, and that's farther out there. But in the equity model, the first one, the sales leaseback, you've given up your most significant asset, and that lease is not going to be sustainable. So most sophisticated multi-state operators have figured out that model is probably not going to work out long term for those lease rates. So if you can not have to do that, then the next one you would consider is, if you want max proceeds, is going with one of our peers for max proceeds. But the problem that you get into there is that the covenants of those loans are so restrictive that if you're going to try to do anything else with your assets, a merger acquisition.
Can you give me an example when you say it's restrictive?
Well, you would have to get a board. They have a board seat, so I don't know what all their covenants are, but they might be things like a board seat. They might be things like you have to maintain a 25% growth of EBITDA every month,
right,
to stay in covenants. You might have to have a certain amount of cash balance at all times, no matter what.
Okay.
You might have to have a certain portion of the accounts receivable be current, or we're gonna collapse that valuation basis in. There's all kinds of things that you might not be able to make any additional changes to officer compensation without their approval. So there's numerous things, and so when you're in an emerging industry and you're looking to be nimble and quick, if you have to go ask your lender if you can negotiate this deal, because you don't even want to start negotiating with them before you know where am I going to run into choke points here, that's a bad situation as you get bigger and bigger. Now, if you need max proceeds, a lot of our borrowers start there. But they realized later that they sold their soul to the devil, in the sense of that now they're stuck in a situation where they can't unwind it because they would need an equity check to come in for us to refinance it. And we said, guys, there's nothing we can do for you.
Now, the TerrAscend deal, that puts you on the East Coast, I believe, for the first time. Is that correct?
Yeah, we look at deals all over the country, across the country. It's not that we're opposed to doing deals on the East Coast. It's just that we're always looking for the highest quality sponsor, the best operator. We're not trying to put a flag in each state. We're just looking at the best deals, whether it's in a unlimited license state or a limited license state across the country. You'll see some more deals come out this quarter that will be in more eastern part of the country.
What's that say about your firm lending money to a company like TerrAscend?
I think it shows the TerrAscend, the State House roll-up of Urban Leaf, Loud Pack, and Harborside. I think it just shows that our firm is able to execute on what we say. And when you run into very complicated deals, just having the money is not enough. You need to be able to execute. And I think that our team is one of the best at executing in the country, bar none, in any asset class.
Knowing your craft, right?
Yeah.
So here we are, beautiful mountains, a racetrack. Is there any way that you could sponsor us where we could move our offices to Newport and do this podcast every Friday?
Buddy, that's something you're gonna have to get your wife to approve. You're good.
Good point. It's a good point.
We're not gonna stop you. So come on over. You know.
What an amazing week this has been, though. But I think most importantly for our viewers to understand is that this industry is barely growing. They understand that. They focus a lot on the equity side, where a lot of their portfolios have been down 70 to 80%. But this is kind of the message that you've been communicating and educating us since we started talking probably 6-7 weeks ago, is re-educating yourself on the industry as a whole. And as you're focusing on the private side and the growth trajectory, as you've outlined to both Ben and I, it's a big opportunity for you, right?
Our goal is, like, we know the industry better than any retail investor is going to ever possibly know it. And I don't even really invest in the public cannabis equities. And the reason for that is that there's just, even if you know or an expert, you've got external factors that are factoring in, and mainly that you're only got a universe of retail investor, and it's so thinly traded, and there's so much volatility in that stock trade. So that, until we get to a place where you've got institutionals, the only one that's got the institutionals that I'm aware of, well, IIPR has 79% of institutionals. I believe that Chicago Atlantic and Advanced Flower Capital have the possibility of having those. So that helps, but all the rest of the direct cannabis companies don't have institutionals. And so, unless they're Canadian. And so without having institutionals, you can't get that volume of trades and enough capital that even makes it worth going public. And I think that people should look at this and realize you're in a brand new emerging market, and you're trying to bet on the upside of something, and betting on the upside of if your investment thesis includes regulation changing for you to hit that home run, that's a bad bet. Just wait and don't try to lean it. You're never going to time it right. There's a lot of things that might happen in between there. Go with a fund manager. I would recommend staying in the private side so there's no volatility, and try to stay in less risky investments. Asset-based is what our approach was. We do get equity upsides in transactions, and so we're able to get the upside that you would be looking for, but you didn't have to pay for it. We got it as an equity kicker to our debt piece. So you can get the best of both worlds here. You know, we're targeted a monthly yield of 12 to 15% monthly with a REIT tax advantage. And so, look, we're not going to get a 10x return, but about every 4.2 years, if you reinvest, you would get 100% of your capital back. So, you know, if you've been in this already for 4 years, you would have already been playing with the house.
4.2 years, you get 100% of your...
That reinvesting at 15%. This year we'll do 12%. We had an enormous amount of cash drag, but we should be back to 15% next year.
Wow.
Well, last question on my end. I have to ask, with the decline in the equity values, are you seeing more interest in your fund from previous equity investors? Because sometimes they're not into debt, but are you seeing more of that?
I wouldn't. I think that people that do equities.
This is all part of the education process.
I think the people that do equities really aren't that interested in putting capital to sleep for 4.2 years to get the 100% return. But in reality, if that's the way that you thought, you probably would have less stress and not be so pissed off the market's down 90%. M4 GTS race car practicing behind us.
How would you grade that turn?
Well, I can't see it, but he's doing all right.
Okay.
He didn't crash, so that's a good day. I think that people just don't have enough information for even investing in. It's like there's so much to know. You should be an expert in the things that you know. Go to the conferences. Don't invest until you have hung out with these people. Get your own. You establish who you believe in what's going on out there. And you know, I just want to be out here to let people know that the industry, the growth of the industry is what we should be focused on.
Yeah.
If we've got headwinds of an enormous amount of each. There's 5 more states potentially coming online. That's a tailwind that nobody else is having in where we're headed in the economy right now. So we're one of the few industries that have it, and being in a sin business, we're going to continue to have sales. So the ups and downs of the equity volatility, we're not going to play that game. And,
no.
and I just wish that I was able to talk to people that before they ever made
I don't think there was
bets.
I don't think there was enough opportunities, you know, when you look at the industry itself. But now as it's maturing, there could be opportunities. But for the average retail investor, obviously, in 1 second here, it's you know, after they put a lot of money into the whole Canadian cannabis landscape and how that unfolded, they want to like learn about getting involved in private placement deals. That's why SPACs obviously took off. But when you look at the private side, and from what I'm learning from you, if there's opportunities like this to present to obviously investors now, I do think you'll start to see a shift because there is interest towards the actual industry itself. It's just invest in what you know and the information that's been presented to you.
Try to make sure that your investment is secured by assets. That's one way of massively de-risking.
Yeah.
Try to get an income yield out of your investment. That's another way of de-risking it, because you're paying down your principal effectively in one way. And the other thing, try to have no share price volatility. In a private vehicle, there's no volatility of the share price. So that's, you know, our investors, when the stock market is down, can come to us and get at par as opposed to having to sell out at a discount. And I think that's a big comfort to them.
So when I introduced you, you're co-founder.
Yes.
Got a partner. Where'd he go? He's behind the camera, right? So are you self-taught, or are you and Dan, your partner,
Yeah.
He's taught you a lot pertaining to the industry?
Dan has taught me everything I know. We've been best friends from high school. We formed the company together. And being best friends is a huge competitive advantage for us, because we never have an issue of mistrust of what the other person's hidden agenda is. And I didn't realize what a big asset that is until I met other partners of other companies and realized you always are having to deal with that. But the other thing that we have an advantage is that I trained under Dan 100%. So his whole philosophy and how he thinks about things is ingrained in me. So we have a similar methodology and thought process of how things are done, and that has trickled down through the entire company now. And that is a stick to your principles. Don't try to cut corners. You know, just take the slow, steady path and do what the right thing is to do. And that doesn't always. People don't always make business decisions.
So did he approach you about the idea of getting into cannabis?
So Dan and I were going to launch.
This is your opportunity to get on camera now, by the way, for all you watching.
He and I were going to launch a fund, and we were trying to decide. The Pelorus fund was actually created in 2010. Now, we weren't going to do back then cannabis at the time. We hadn't thought about that. But as we were ready to get the fund going, Dan likes to research. He does enormous research, and he wanted to do cannabis. I knew the challenges were going to be so substantial to raise that capital that out of fear, I just like, buddy, I don't think that we can raise the capital. I think we should do 2 funds. And I was trying to take the easy way out. And so, you know, we were going to do 2 funds. And as I thought about it, I'm like, then we're going to be cannibalizing any capital we raise, we're cannibalizing one fund or the other. We got to only have, we've learned over time, you only want one opportunity that you present. And I'm like, you know what, let's frickin' go for it. And, you know, if I would have known how hard it was to get the capital raised, we probably wouldn't be here. But once we're going, we don't stop. And
you ever stop and wake up and just look at the growth that you've done so far and what the horizon presents?
You know, today it's hard.
And I mean that humbly. Like it's
hard to think about that, because the start was just as far to the other end of the spectrum.
Right.
So the first year, 1.65 million assets under management. The second year, 6.5. I mean, this is peanuts. We've done like $5 billion worth of transactions. This is horrific. I had fired myself many times. I didn't tell the end, but nobody else showed up for the job. So until I could replace myself, that was the only one willing to take it.
Yeah.
And after many trials of trying to create a new lane of investors, a new approach, and trying different things, and all of them failed for years of what traditionally worked. And eventually, around 2020, it finally took off. And I think that was a combination of us learning how to present our stuff better, refining our processes, educating in a better way, and just bringing on better supporting assets. And the vernacular was really important too. But the other thing that happened at that time was COVID happened, and most retail investors switched to maximum liquidity for their household.
Yeah.
And eventually they realized COVID isn't, I think it's overhyped. It's not that bad for my family. I'm relatively healthy. I'm going to get this money back
Something
out
we'll
working.
live with, right?
And we also, at the same time, converted to a private mortgage REIT for the tax advantage. And that changes their tax base for an individual for state taxes. You only pay taxes in the state you're domiciled. So we had this massive inflow of investors that wanted to get money working that was non-volatile, because we had a lot of volatility back then in March of 2020 as well, and they felt safe that they could put money here. It had no volatility. They could take the money out after a 6-month lockup. They had the mortgage REIT tax structure benefit, and they didn't have any state tax. A lot of our investors from Texas and Florida had no state taxes, so we just got massive inflows. And once we were getting those inflows, it just took off, and here we are today. We're.
Are you able to share how many investors?
We're just over 1,000 investors at this point.
And what kind of growth do you want?
So we believe that we'll round this year. We're 370 by the end of this month. Assets under management. We'll be very close to 500 million by the end of the year.
Okay.
So we've got transactions that are coming down that'll put us there. And with that, if we can do that at the last quarter of this year, to get from 500 to $1 billion in next year, I mean, we'll probably do it in the first couple of quarters.
So the first couple of years, basically friends and family raising, and now you're lending TerrAscend for $45.5 million.
But like back to what you said, is it like we're always humble, but it was such a struggle, and I'm still picking the glass out of my knees and my elbows.
You got to risk it to get the biscuit, right?
So
and now you're there.
Yeah,
right?
and now we're here,
and we've got work to do, buddy. Anyway, this has been great. Honestly, thanks for having us out. But most importantly, for you, the viewer, leave a comment below. What do you like to see as far as trends within this industry? Any questions that you want, feedbacks that you want, let us know what those are so we can reach out to these thought leaders and answer the questions that you want to know, to most importantly, teach you and get you the answers that you want. As well, click on that bell for notifications, and if you like what we're producing, then obviously subscribe to our channel, because without you, we would not be here. It's been awesome this week, my friend.
Yeah. Let's give a quick shout out to the BMW Performance Center here in Thermal, California. Awesome place, and we can probably give them a plug too. They always take care of us. Yeah. They taught us some cool things with the skid wipeout. It was just like, Shad, quit looking out the windshield, to the side, to the side, to the side. But very cool. I think actually I'm a little bit of a better driver after today's, I guess, kind of. Let's hope. Yeah, exactly, right. Anyways, appreciate it, Rob. Right.
Hey everyone, thanks for watching. So what'd you think of the interview? If there's any information that you want to know more of or want to learn about, then provide us with feedback by leaving a comment below. And if you like what we're producing, then feel free to subscribe to our channel, share this video with your network, and as well, click on that bell for all notifications, because we would not be here without you. We appreciate it. Thanks for watching, everyone.